Hey guys, I hope all of you are doing well. My name is Vatsal and welcome back to my YouTube channel. It's been a while since I posted a video, but this is a video that I'm very excited about, to be honest. And its message is very simple, but it's powerfully very intuitive and gives you a very solid base, building on which you can actually pick stocks. But before I start the video, big shout out to Ace Investor Gautam Bed for including my power of compounding video in one of his online courses, which has gained a lot of traction. So I think that's the best any sort of person can do, is create innovative, good content, which is very easy to grasp and actually delivers the message in an educational way. So without further ado, I'll start my presentation, and I'll broadly discuss the entire aim of this presentation is that if you've ever been confused about which stock to pick, how to go about analyzing stocks in the first place. For example, you have some spare cash left, or you want to deploy it in the markets, you want to invest it in the markets. How exactly do you go about which stock to pick from a very first principles and fundamental way, to ensure that your reasoning is not just sound, but you actually end up making money, right? That's the most important thing, right? So before I head into this, let me tell you that this is not investment or financial advice. You should do your own due diligence, and this video is for educational and informational purposes. So the concept that I'll introduce today is called the anti-fragile stock. Now, before we select any stock, right, let's do a simple thought experiment. Now, on your screen, you can see that there are four stocks, right? A, B, C, D. What's the, just thinking purely from a thought experiment, from an introspective manner, what's the first thing you notice about all these stocks? I've done nothing over here. I've just plotted their share price as a function of the year. So year after year, how's their share price performing? That's all that these graphs show you. The most stark observation is that the stock price is consistently increasing as time passes by. Now, there are periods where the stock price has sharply corrected, and these are typically periods where either there's a large financial crisis or a large economic shock, like the 2008 financial crisis or COVID-19 or the taper tantrum or things like that, where currently we have the Evergrande correction going on. So these small blips are the economic shocks, but on the whole, you do see that the share price is consistently increasing over time. So yeah, keep this in mind as we go through the remaining slides, right? Now, these are four other stocks, which is again plotting their stock price as a function of time. So I just see how their stock price is performing, and over here it's not that good a picture. Stock D, for example, would have consistently made you poor had you bought it in 2012 or 2016 or 2018, whereas stock E is quite cyclical in that it has its phases where it's rising and falling, rising and falling. And similarly, you can see with stock F and stock G that they are not consistently rising with time. And the main part that I want you to take away from this slide is, for stocks like these, you need to be a very good market timer. Now, Warren Buffett himself has said he's not a good market timer. So if he doesn't think so, I don't think any of us can claim that we're good market timers, in that we exactly know when the stock price is going to fall, so we can pick the stock up. We know when it's going to rise, so we can sell it after that, right? So I've basically shown you two slides over here just to recalibrate. The first slide, I have basically shown four stocks that have consistently increased over time. And I've shown you four other stocks where you don't really know where the stock price is going to go at any given point of time, right? So the first thought experiment that I want you to get out of this is this a good criteria to select stocks? So the first thing is, if supposing I have a stock idea, if I think, for example, Reliance Industries is a good stock to pick, the first thing that I want you to do is just Google the stock and just find out what the share price looks like in the last 5-10 years, and you'll get a broad understanding if it's rising over time or if it's cyclical, and it would have consistently made you poorer. Now, the next question that I ask is, would I make a lot of money by holding these stocks, right? The answer is yes, and with a very high probability. So if I look at stock B, for example, in this chart, it doesn't matter if I bought this stock in 2010 or 2012 or 2014 or 16 or 18 or 2020, I would have ended up being richer. My money would have given me a good return. Similarly, for stock D and stock B and stock A, no matter what point in time you buy these stocks will always give you money. They will always return you money because that's the fundamental nature of their business, right? So as a criteria, whenever you're confused about which stocks to pick, this is a good filter to apply from the get-go, that are these stocks rising or not? But the question is, aren't these stocks expensive? Because we can see that every every 6 months or every 1 year, the stock is hitting an all-time high. So it can be notionally expensive. That's the first sort of conclusion you can take away. But I'll address this later on. So the idea that underlies these types of stocks A, B, C, D that I showed you earlier, and once again, if you stick around till the end of this video, I will reveal which stocks these are. So that's an incentive for you to stick around till the end of the video. But going on, so I want to introduce the concept of anti-fragility, which I think is extremely simple, extremely intuitive, but very powerful when it comes to investing. So this concept was introduced by Nassim Nicholas Taleb in his book called Antifragile. And anything that's anti-fragile basically improves or gets better over time as it experiences more and more shocks and volatility or chaos. So if you shock any system, if you give it any volatility, if you introduce chaos in any system or in any object or any individual, but that person or individual or system improves by getting that shock, then you can call that thing anti-fragile. Now, what are the examples, like very practical everyday examples of these things? The easiest is vaccination, right? When you're vaccinating yourself, you're essentially introducing a new germ, you're introducing a shock to the body, but the body, because of getting that, is in fact further improving itself. It's getting better. Similar with exercise. You're causing pain to your limbs, to your joints by exercising notionally, but they do get better over time. Artificial intelligence, where you feed the more data, the more scenarios, the more information you feed it, you are introducing a shock to that model. You're introducing some sort of volatility to that model. But the AI is going to get better. And similar with the brain. And the best example is, if you've seen a child learn, a 1 or 2 year old child, how quickly they pick up things, it's because they're getting volatility, they're getting shocks from the outside world all the time, but their brain keeps getting better. So these are anti-fragile objects in and of themselves. But what's the biggest test for something being declared as anti-fragile? The biggest test is, what's the performance over time of that object? So for example, when you exercise, right? If you consistently exercise, if you consistently expose your body to shocks and pain through exercise, over a period of time, your body's performance is improving. So the biggest test, if an object is truly anti-fragile, is to only see, and I repeat, only see if it is improving over time. Because time is the biggest introducer of shocks. As we go across time, there are more and more shocks that enter a system. So for example, in 2008, we had the financial crisis. Between 2008 and 2021, we've had so many economic shocks, geopolitical shocks, trade tensions, etc., right? Central bank interest rate movements. So these are shocks to the system. But across that period of time, there are some companies that would have improved and some companies which have either gone bankrupt or are not doing very well for themselves. So the biggest takeaway I want you to take is, anything whose performance improves over time is anti-fragile. Therefore, this is the big takeaway, that simply look for stocks whose price appreciates as time passes by. Now, you must be thinking, Vatsal, like what's this nonsense, right? This is so simple to grasp. Like, you don't need to make a YouTube video for this. Anybody can do this, but what I want you to do is take away the underlying intuition as to why is this exactly happening. And the surprising part is only 1 or 1.5% of stocks in the entire stock market, whether it's the US stock market or the Indian stock market, actually show this property where their price truly appreciates over time. And these stocks are basically consistent compounders, or stocks where you can actually compound your wealth through. So it may sound very simple and straightforward, but the idea that as long as a stock's price is appreciating over time, it is anti-fragile. And what we should do when researching stocks is basically look for anti-fragile stocks, right? The best part about these stocks is they have faced multiple election cycles, they've faced multiple economic shocks, but their underlying business is not affected at all. So my favorite example is Asian Paints, right? There have been multiple prime ministers during the time that Asian Paints has been in business. There have been many RBI governors who've left and joined office. There have been a lot of trade tensions, a lot of geopolitical tensions, but that does not affect Asian Paints' underlying business. And the best reflection of that is the stock price, right? Even in fact, during COVID-19, Asian Paints' sales grew by 90%, which is either their sales or their profits, one of the two, grew by 90%, which is insane. So a shock like COVID-19 has made Asian Paints better, right? So that's the key takeaway. So next time when you research a stock, what I want you to do is see if it passes the anti-fragility test. This is something I do myself when I pick stocks. But let me tell you, this is not the only way, obviously, to make money. There are thousands of ways where investors have figured out to make money for themselves. But this is a very safe and intuitive way to make money. What are the common traits of companies that pass the anti-fragility test? In my experience and from my research, there are basically three traits. The first is the company has to have a high return on capital employed. It's as simple as that. In the Indian stock market, anything above 25%, in the US stock market, anything above 13 or 14% is considered very high return on capital employed. And this is something you can get either from the balance sheet, or if you do a Google search on the company, you'll get this ratio. The second is these companies have very high reinvestment rates. So because what is happening is they have a high return on capital and they have a cost of capital, right? That gap is free cash flow. And what they're doing is they're reinvesting that free cash flow back into the business, right? And companies which show this anti-fragile property have very high reinvestment rates. And because they have high reinvestment rates, they also have low dividend payouts to their shareholders. So if they have free cash flow, they will simply not just give it to the shareholders as dividends. They will redeploy that back in the business. Now, the biggest question with anti-fragile stocks, so two anti-fragile stocks that you can see in this slide is Berkshire Hathaway from the US stock market and Asian Paints from the Indian stock market. Now, a very common question is, Vatsal, Asian Paints is currently trading around 3,000 rupees. Why should I buy it now? It looks so expensive. But that's the fundamental part, that had you bought Asian Paints in 2008, 2012, 2016, 2018, it would have always looked expensive in hindsight. But because these stocks are anti-fragile, these companies are anti-fragile in nature, their business models are anti-fragile in nature, their stock price has always increased. Similarly, for Berkshire Hathaway, the price of one share of Berkshire Hathaway is north of 2.5 crore rupees today. But that does not mean shareholders do not buy into it, because if you see this chart, the price has only consistently increased and it's given you a very good rate of return. And finally, because for those of you who have stuck around till the end of this video, I'll end up revealing which stocks I had initially shown, and you'll be surprised, right? The stocks which did not perform well, which did not pass the anti-fragile test, are in fact household names. They're considered to be very good and very profitable companies, but their stock price, but holding their stock would have made you poorer. So the four anti-fragile stocks that I had initially listed in the first slide was Relaxo, HDFC Bank, Nestle, and Pidilite. And this is just an Indian stock market example, right? We can also see this in US companies like the tech giants, Facebook, Amazon, Apple. But apart from that, even like very simple companies like Clorox Clorox sells bathroom phenyl, right? It sells bathroom disinfectants, but it does its business so well that it's always made shareholders very happy. Even if you look at its stock price, it's consistently increased. Same is the case for a company like, say, Cloudflare, and so on and so forth. But the idea is you should ideally have data for at least 5 or 10 years, and then you can make a safe bet that this company is actually anti-fragile. And stocks which are not anti-fragile, you have the likes of Tata Motors, Adani Enterprises, Coal India, PFC, Power Finance Corporation. So if you would have bought these companies, you would have had to be very smart in your market timing. And you would not know when to exit or when to enter, because you really don't know where their share price is going to go from a historic perspective. Finally, I won't take much time, but the broad conclusion that I want you to take out is that the expensive or the valuation argument does not concern to them. It does not matter what their PE multiple is. It does not matter how expensive the stock looks. They hit an all-time high every year or every 6 months anyway. This strategy is very good for long-term investors, the buy and hold, or even better, the buy and forget kind of category of investors who want to buy a stock and just let it compound and sit and watch their returns over time, right? And such stocks can be found in all stock markets, whether it's US, India, Vietnam, Shanghai, like wherever. You will find companies like these. So thanks a lot for sticking till the end. If you thought this could be of some value, please subscribe and comment, and like the video. And if you think I could have done a better job or I could have articulated better, please let me know, and I'll definitely incorporate that feedback in my next video. So thanks a lot for sticking around. Take care, and all the best to your investment portfolios.